Well, there are really two big things going on in the background of the market recently. It's what's going to happen if we see the Trump tax cuts and tariffs come into play, and then what happens to the broader market if the yield curve uninverts. Obviously, this is a very big week for markets, and so we could spend the time talking about the earnings or the non-farm payrolls, the FOMC, but we'll leave that market commentary to other programs here. I want to talk about these bigger picture ideas. First off, with the Trump tax cuts and potential tariffs, I think the most important thing for people to consider is where do we stand in the macro cycle? Even though Donald Trump became the presumptive frontrunner on June 27th following the debates, one sector in particular that people would have anticipated to do well is actually not doing well and has been struggling since then, and that's energy. Energy did really well under President Trump, given all of the expansive deregulation efforts that he did, all the drill baby drill efforts that he put forward. But this time is a little bit different because when he came into office in 2016, it was on the heels of the 2014-2015 oil market bust. This time around, Donald Trump could be entering office with U.S. production at all-time highs. The United States is now the world's largest exporter of LNG, in recent years overtaking countries like Qatar and Australia. So drill, baby, drill at this point in time may just mean introducing more supply to an already oversupplied market. Deregulations could help profits at the margins, but in terms of unlocking new potential moving forward, this is a market that is significantly oversupplied. And OPEC themselves, well, they've been cutting for years, so they could always bring that back to the table. I would be less interested in trying to play energy than I would be trying to play defense if you look at the returns. Not only has Trump promised to look up and spend more money for the defense sector, he wants to spend more money domestically. So domestic manufacturers should benefit more than someone else who, say, imports their goods from abroad. A company like Lockheed Martin, I think, should be on people's radar, not just the entire defense sector, but a company like Lockheed Martin, which does one thing and one thing in particular. It makes drones for border security. So a second Trump term may be of interest to those defense manufacturers that do things that provide, well, UAVs to make sure that there's a digital wall against Mexico as opposed to an actual physical one. But there's a final company that's popped on my radar in the energy sector that actually probably is a little out of the box, and that's First Solar. First Solar is a clean energy company, Chris. Why would that benefit under the Trump tariffs? Well, that's exactly why it would benefit. First Solar makes its solar panels here in America. Most solar panels that we have in the country are manufactured abroad. If tariffs come into place, you're going to see companies that have been less competitive here as American startups all of a sudden rise to an even playing field. That's not good news for consumers because they're going to have to pay those higher prices, but it does mean that those domestic companies here at home are going to have a better shot. I bring all this up because I came across another great Stanley Druckenmiller quote in recent days where he mentions that he's sitting at a dinner table and everyone's talking about my stock this and my stock that because it has free cash flow and it's growing and it's impervious to whatever's happening in the world. And he points out that about 50% of any given stock's move is attributable to the broader market, another 30% to the general sector that it resides in, and then the other 20%, that's the winners and losers, the stock picking that comes into play. For most people like us, we're really just concerned with that first 80% of the game. We want to make sure we get the market direction right. We want to make sure that we're focusing on the right sectors. So if Trump becomes an increasingly popular pick to become the president, I'm thinking, how can I get more exposure to those domestic manufacturers? How can I get exposure to domestic banks, regional banks, which in turn can help provide the financing for those small and medium-term enterprises? That would benefit if those tariffs are erected. Tom, you have to have a name on the other side, though, and it's been a real dog recently. A company like Nike, which has had problems because of various consultants, I'm not going to say McKinsey, but we'll leave it there, that have come in and destroyed the business. But a company like Nike is really dependent on its goods from abroad, and it would suffer greatly, in my opinion, like it struggled under the first Trump term, should those tariffs come into play. So let's focus on America if Donald Trump is going to be the president.
It's a very interesting perspective. There's only one flaw. Well, there's a couple of flaws. The major flaw that jumps out to me is that the market sees into the future better than I do, you do, Tony does, or everybody else, or the totality of all the money flow that's out there. The reason that these stocks seem like they aren't acting like that you would think they would under a Trump presidency is because I think Trump is going to lose and lose big. And the market also thinks Trump is going to lose. The reason that people aren't trading, the reason the Trump trade is essentially dead is for two reasons. One, because of a very big change in sentiment in a short period of time. I mean, he's essentially lost his lead, and it's really flat right now. It's let's call it a toss-up. We haven't even got to the Democratic National Convention yet, so let's just assume it's a toss-up all the way to the end. And let's not even say, because at some point Harris will be winning, and at some point Trump will be winning again, and it'll go back and forth all the way to Election Day. Within about whatever the margin of error is, nobody's going to know. Nobody's going to have any clue up until Election Day. So it really comes down to, that's one of the reasons the Trump trade is dead, is because he doesn't have any kind of lead. The other reason is because there is very little trust or belief in his policies among Wall Street. Wall Street doesn't care who wins. Wall Street right now says, I don't care if it's Harris and whoever, or if it's Trump and whoever, because neither person is going to get anything done. So everything is going to remain status quo. I don't believe in Trump's tax cuts anyway. I don't think he'll be able to push anything through. And I don't believe in his tariff, even if he wins. I don't believe in his tariffs, because tariffs are just bad for business. And I don't think that in the end, his backers are going to be supportive of tariffs. I think that his backers are actually on the other side of that. And he's easily, swayed by money flow. So I don't actually think that the tariffs, at least that's the way the market's trading, the market doesn't think it's going to come into play. And if it does, it thinks we're going to be in deadlock or gridlock. So right now, there is no Trump trade anymore, and there's no Harris trade either, for the record. It's just, it's gridlock or deadlock is the projection, which is good for the stock market. Let's not kid ourselves here. So the stock market has remained relatively strong. I mean, we're just,
volatility relatively low.
Volatility relatively low. We're just off all-time highs. I mean, I would expect the next 100 days, you are going to see a drift higher in volatility, and you could see some nervousness in the market. We're seeing a little bit of nervousness in the way the trade is, just in general, the way the S&Ps are flying around. But to tell you the truth right now, there's no fear of either candidate. I mean, despite what everybody says and all the fear mongering that goes out there, and just the political rhetoric. Right now, the market's not scared of a Harris presidency, and the market's not scared of a Trump presidency at all. I don't think either one is going to have much effectiveness when it comes to economic policy. And why would you? We have the strongest economy. We have essentially the strongest economy we've seen.
Ain't broke, don't fix it kind of thing.
Yeah, exactly. It ain't broke. There's nothing to fix. Everybody that's sitting around, the only thing that's wrong with the economy is from people that are just trying to make a political statement right now. There is nothing wrong. It's as good as it gets. And so why would anyone try to break this? Keep it going for, and also, in the case of Trump, you have a lame duck, so it doesn't matter. I just don't see much changing at all. And I see a continuation of current policies. And you'd be crazy, like Tony said, if it ain't broke, don't fix it. And I think you'd be crazy to change anything right now. Market's too strong. The economy's too strong. Either way, you start messing with it, you're going to get negative feedback. So I don't think there is a Trump trade at all. And I don't think there's a Harris trade.
Pretty clearly, the market really does not care if it's Democrat or Republican office. Market direction historically tends to be up. The question is, if the market's going up, which sectors are leading? So regardless if you like Trump or Kamala or don't like either and you're voting RFK or Jill Stein or Cornel West, I mean, that's not the point of this conversation. The point is, if a president comes into play and they have a certain political coalition with them in Congress, what type of changes can be enacted that would ultimately shift the flow of capital in financial markets? And so it's worth having a watch list, I think, for various scenarios. If a Republican trifecta happens, a Democratic trifecta, gridlock with a GOP president, gridlock with a Democratic president, right? And that way we know basically where to look. We don't need to do the stock picking. These industries tend to do better under these types of presidents with these policies, vice versa. It's not a political commentary for me, but watching how the market has evolved, I find it very, very interesting that the energy sector in particular has struggled since June 27th, given how Trump has been so friendly towards being pro-energy independent. And yet it's coming in the context of oil production and natural gas production in the U.S. at all-time high. So what does more supply do at this point in time? It might hurt prices, which could not be good for the company. So it's not just a straight shot. It's not just a replay of what happened in November 2016 and 2017 when the market had that very aggressive adjustment because Clinton was favored and then Trump won. But this is definitely still worth watching. I don't know if there's going to be a trade there today, Because if the market goes to even, Tom, as you point out, then gridlock becomes the base case, and then there is no Trump trade or Kamala trade, and that only gets resolved once we see what the composition of Congress is and who's the president after November 5th. And so that's a long time from now.
Yeah, I agree. And I think the market's got an awful lot of challenges ahead of it because of where it is, just relative to where it's been to start this year and where it is. And also that you're losing your leadership. Clearly to me, there's been a little bit of a change of right now, the leaders are struggling, the old leaders. And, NVIDIA's, it's hard to say it's struggling given where it is, but it's down, whatever, 20, 30 bucks off its high. And some of the other stocks, AMD.
Fair market.
Yeah. I mean, AMD, Google, Amazon, they're all down a little bit off their highs, whether it's 10, 20, 30 bucks, whatever it is. But they've definitely, the bloom's off the rose a little bit on the old leaders. Are the new leaders going to be strong enough? It's way different when you have a $3 trillion company leading the market as opposed to a much smaller company like a couple $100 billion. Very different animal. Let's see what happens. To me, the S&P futures and the broad-based indices are still plenty strong. They still rather go up than down. We'll see. This is the time of the year in past election years.
Is that a seasonality reference?
No, it's just we're getting closer to, it's not seasonality. We're just getting closer to election time.
Watch yourself, Chris.
When you think about 2008, it was late summer that the market started to get, crazy volatile. We're getting into August, right? Isn't August the end of this week?
Yeah, today comes the 30th. Today's the 30th. There's only 31 days in a month.
So we're about to get into August. When we got into August in 2008 is when we started to, let the games begin. Same thing, much lesser extent in 2012. In 2016, it started a little bit later. It was like September, October. And 2020, we were already in a free-for-all because of the pandemic. So it's a little bit weird in 2020. This is the time of the year, August of election years, when you start to get, it's almost game time. And so you start to get a little more activity. You can see heavier volumes. We've been seeing heavier volumes in the S&Ps every day. We're definitely seeing whippier markets. There's been a lot more intraday reversals recently than we've seen for the first 6 months of the year. We're in a pretty interesting place. I just don't.
Time to be alive.
Yeah, I think you're going to see a lot of posturing, but I don't think you're going to see institutions set up for either administration. I don't think that's the play right now.
So before we close this out here, guys, on July 16th, we talked about the move that occurred on July 11th in the Russell 2000 outpacing the Russell 1000, how it was the fifth largest move in that pair's history, and the other four instances all occurred right around significant lows in the market. Last week, some more of those really esoteric niche, can even rely on them type of stats appeared for the NASDAQ and the S&P as well. And just something to think about here as we go into the commercial break. Last week, when the NASDAQ was down on Wednesday, it was off by more than 3%. Advancing volume flowing into advancing stocks outnumbered the volume going into declining stocks. Why does that matter? It's only happened once before in history. Over 40,000 trading sessions in the NASDAQ, and this is only the second time in history it's occurred, the other time being July 15th, 1995, which was the week of the low for the rest of the year. And then last week on Wednesday, the S&P fell by more than 2%. 164 stocks were higher, though. Since 2000, an average of 42 stocks are up on days when the S&P is down by 2 or more percent. So the past two times it was down by more than 2% with 100 components higher. March 23rd, 2020, the low, and February 27th, 2009, 2 weeks from the low. So I'm not saying the bottom's here. And those stats come from Ryan Detrick, CM Chief Market Strategist at Carson Group, and then Jason Gofert. So I have to just make sure I give proper attribution. We've been talking about this on Twitter recently. But you're getting some really big exhaustion type of signals in the market that I'm having struggle putting faith in, but they're difficult for me to ignore.
There's no question that that's an interesting stat. I don't know if I would close my eyes and buy them based on that stat, but it is an interesting stat to have in the back of your mind. But again, it's been that kind of market for what feels like a long time. It just feels like it. It feels like there's been like no correlation to one. Everything seems to be going its own way. Even on down days, there's crazy stocks that are up, and on up days, there's it just seems weird. Today's another day like that. The Russell's up, the S&Ps are up, the NASDAQ's down.